Hi there. Thank you for attending today. This is Rick Schwartz, who's one of the partners with Schwartz & Schwartz CPAs. On behalf of our firm, I'd like to welcome everyone to today's webinar. Before we begin, I'd like to tell you a little bit about us. Andrew and I started the firm back in 1993. This is our 25th tax season together. We've grown every year. Currently, we have about 20 year-round staff, and seasonally, we bring in another 10 people each year. So it's a busy time of year this time of year, but it's a good opportunity to touch base with all of our clients that we don't touch base with during the year. Since our beginnings, we've focused on serving the healthcare professionals, their families, their practices. We try to offer a comprehensive menu of services for the convenience of our clients, including tax prep, accounting, payroll, college and financial planning. Our goal with offering these financial boot camps is to help you become financially fit. So just what does that mean? What is financial fitness? Well, to us, it's being well-informed, confident in your choices, and pursuing a solid plan to reach your goals, your financial goals. When deciding who to team up with to present these sessions, it was an easy choice for us. We've been working with First National Corp for a number of years and had a great relationship over the years with them, going back close to 20 years at this point. So at this time, I'd like to introduce you to Alex Oliver, who will be representing or presenting today's webinar. Alex is an investment advisor for First National Corp, and he's been with them for since 2015 after graduating from UCLA's Personal Financial Planning program. So I'd like to introduce Alex. Thanks for joining us today.
Okay, great. Thank you, Rick. That was a great introduction. And again, thanks everybody for joining us today. I know your time is very valuable, especially during lunchtime at work. So we're going to try and give you something to take away from today's presentation. This is the first of 4 in our financial fitness boot camp, and today's is certainly the most broad. So a quick and dirty personal finance checkup. We're going to cover quite a few things today, and I'm sure you'll be able to take 3 or 4 things out of this. Just to round out that great introduction from Rick, First National Corporation, we're located in Rockland, Massachusetts. Been in business for over 30 years now. We have 2 sides to our business that you should understand. One is on the wealth management side, where we work with about 450 individuals and families, helping them to hit their retirement goals, manage towards a college savings plan, mitigate their taxes as best as possible, and certainly working with great partners such as Schwartz & Schwartz on the accounting side, other state attorneys to bring the whole financial picture into focus. And then the other side of our business is working with retirement plans. So we serve about 50 401k plans, as well as simple IRAs, cash balance pension plans. We service the fiduciary on those plans across New England. Fiduciary meaning that we are in a position to act in the best interest of our clients. So we don't sell products here. We don't have affiliations with any other investment companies. And so we essentially are in the position to play quarterback, if you will, to help wherever we can. So with that, I'm just going to give a quick disclosure for today's presentation. We're going to make a lot of broad generalizations and broad recommendations. The takeaway here is that you should be doing your own due diligence, consulting with an advisor or other trusted confidant before enacting any strategies we talk about today. Certainly, these principles can vary from person to person, situation to situation. Just to piggyback on that a little bit, I will tell you that today's presentation, again, is very broad, and we're going to be covering many topics very quickly. You can really break this down, I think, into what stage of life you're in today. Whether you're in the earning phase, where you're early on, kind of just getting your career started, whether now you've started to get out of student debt and you're starting to put away money, the growing phase where you can now start to focus on your investment portfolio. Even though you've got 6 digits saved up, 7 digits saved up, investments are a little bit more important. And then, finally, the person that's in their 60s that are getting ready to retire or have already retired and trying to preserve their assets. As such, this presentation really lines up with that somewhat chronologically. So if you're, closer to that late stage where you're going to get ready to retire, or you have retired, maybe the back end of this presentation will be more relevant. For somebody that's a little younger, certainly the early parts are the ones you want to listen to. So just giving you a heads up on that. I like to graphically show our wealth pyramid here, and this is essentially what I'm trying to build with any client that I'm working with. When I start working with somebody, trying to get the foundational building blocks into place before getting to the more, let's just say, exciting or interesting topics. So today, we won't really be talking about the top couple of blocks there: legacy planning and charitable giving, wealth building and diversified asset accumulation. Those are great to talk about, but for today, we're not going to dive into. We will briefly dive into life insurance, disability insurance, short-term liquidity, estate planning. We will definitely spend some time on retirement savings, so you can have some benchmarks to see where you stand against other people, as well as some college savings benchmarks. Again, I should emphasize one more time that we do have 3 more presentations in this series, one on student loans, one on estate planning, and one on saving for your children's education. So while I will cover those topics for 2 or 3 minutes today, be sure to tune into those for a little bit more deep dive on those. So I figured instead of starting with 0, let's start in the negatives today and starting out talking about student loans. Student loans for many Schwartz and Schwartz clients and ours ourselves at First National Corporation are really the foundational block for the rest of the financial plan. I just have a few statistics here about how much this might affect you in your financial plan, whether that's getting married or having children or buying a house. These 6-figure debt levels, some of our clients have $500,000, $600,000 in debt just before getting started. And that can really feel burdensome. And so one of my first things with a client like that is to figure out a plan for the student loans. And so again, while I won't go into too much detail today, I just want to bring a few things to your attention. Just a couple of common mistakes that we see people make before coming to see us might be confusing federal versus private loans and exactly what that means for the financial plan. I'll talk about that more in a second, as well as not fully understanding the power of interest when deferring or entering forbearance. Okay, so there are a couple of repayment programs out there that you should be aware of. Again, I'll talk about soon. But just to give you an idea first, you likely already know this as far as putting extra payments into your student loan payment plan and just how big of an effect that might have on getting those loans tackled early. I know that a $200,000 or $300,000 balance can feel over cumbersome, but a few extra dollars here and there can pay off a big deal, as you can see graphically here. But as far as getting the plan in place, there are a few questions that you're going to want to ask as far as tackling that gorilla. With private loans, there's not a lot to think about. Private loans, we can't go into a repayment plan. We can't get it forgiven. So private loans really are just, can we get a lower interest rate on that? And we'll talk about how to do that here soon. But with federal loans, there's a lot to think about. One example would be if you are getting into the nonprofit sector. There's a program called the Public Student Loan Forgiveness Program, where if you work there for 10 years at a qualifying institution, your loans are completely forgiven, okay? And that, again, can be a huge thing for somebody with $400,000 or $500,000 in debt to have that forgiven completely tax-free. For someone like that, they may be choosing to do a combination of strategies where they have a payment plan. There are a few out there called income-based repayment, IBR, repay, which is revised pay as you earn, that might cap what your payments are going to be while you accumulate those years towards public student loan forgiveness. At the same time, you may also, in that position, think about filing your taxes separately instead of jointly. So if you have an amazing amount of loans, but your spouse does not, and your spouse has a higher income than you, filing separately, while you may end up paying more in taxes over those 10 years, it might make sense to do that because you're keeping your payments low while you accumulate years and eventually get that forgiven. So that's certainly a break-even analysis that you might do with your accountant or your advisor. If you're not going into public student loan forgiveness, there still that option of revised pay as you earn is a great thing for a resident, as an example, or somebody just getting their first couple of years that still has a lower income while they get the rest of the plan figured out. So, before you consolidate your federal loans, before you go and refinance into private, you want to make sure you know exactly what your career trajectory is, because you lose a lot of benefits before refinancing. And again, that's a tough thing to lose just to get your interest rate down from 8 to 5%, as an example. So again, we will cover that more in another presentation. Next building block, and maybe even concurrently with that, would be how to build your credit score. Again, as you know, you will be looking at this score for many things, as far as refinancing your loans, applying for a mortgage, getting approved for a building loan, things of that nature. Just wanted to bring to light how exactly your credit score might be looked at, because most would know that your payment history, whether you're paying on time, adds to your credit score. Some may not know exactly how the amounts owed affect your credit score. So one thing that I've done for the last few years that you may want to think about doing, especially if you're a couple of years away from refinancing your loans, would be looking at how much available credit you have, and then what percent of that you are using, because that's what they're looking at for your FICO credit score. So as an example, if I have 3 credit cards, a Visa, a MasterCard, or Discover, and they've given me $30,000 in credit limits, and let's just say I'm putting on $10,000 a month on those credit cards. I'm paying it off, but I'm putting it on there every month. I'm using about 33% of my available credit. Now, if I had spent a few years asking for an increase in my credit lines, maybe now I have $100,000 in available credit, but that $10,000 I'm putting on there now says I have a 10% credit usage rate. So basically they've said, Alex, we've extended you all this credit, but you're not using it all. So therefore you must be a good responsible person. So my credit score is going to be higher. A great example of this that I like to tell is a client of mine that wanted to refinance their student loans, and their credit score was in the 650 range. And a big reason for that was because she had taken out a mattress loan that was 0% interest for 3 years. So a great deal. But basically, out of that $3,000 limit that they had given her, she was using $3,000 of it, 100%. So after I learned that, we put a payment on there of $2,500. Within 2 weeks, her credit score jumped from 650 to 720. I didn't even know it could move that fast, but it's pretty remarkable how just a little bit of planning can really help put you in a good position there. So just some things to think about. I should have just mentioned really quickly that bottom website, creditkarma.com. I would write that down if you've never been on there, just to check your credit history, make sure it's accurate, and your credit score as a whole. Moving on, we're going to talk about the emergency fund and short-term liquidity. Obviously having an amount of cash on hand for an emergency such as a job loss or car repairs or medical emergencies is important, so that way we don't have to rob the retirement accounts or sell investments at an inopportune time. We like to say 3 to 6 months worth of non-discretionary expenses. So basically your mortgage payment, your auto payment, your food, your gas, the things that you're going to need every month to get by. I actually typically see people with too much cash on hand. They might have, say, $50,000 just sitting in a savings account, or $100,000 because they just are paralyzed, if you will. They don't know what to do with the excess cash. And we would encourage you to take a look at your expenses. Let's just say you're spending $5,000 a month. You want to have somewhere between $15,000 and $30,000 in some sort of liquid, stable account. This doesn't have to be a checking account. It could be something like a Roth IRA. If you want to use some of the contributions out of that, you can actually take those out tax-free and penalty-free. I know some people use a home equity line of credit if they've already paid off their house, as an example. So there are a lot of options here depending on your situation, but just make sure you have some access to capital. Okay, let's keep going along here. My next topic is just disability insurance. Disability insurance, I even put before life insurance due to the fact that you're about 4 times more likely to be disabled by age 65 than you are to pass away in that time. And this is a really important topic because as a young person, your greatest asset as a 30-year-old is your ability to earn money for the next 30 years. It's not what you've saved so far. You probably don't have a lot saved up at that point. So disability insurance is key. And of all the slides I have, this might be the most broad one as far as don't take this recommendation for yourself, because we do have some broad numbers about 60 to 70% of your gross income you should have for disability insurance, but that really does vary. And I would say it varies based on your monthly spending. So, we certainly have many clients, dentists as an example, that are making well into the six figures, but maybe are keeping their personal expenses very low. That person doesn't necessarily have to have 60 or 70% disability coverage. They might be able to get by with a little bit lower than that, but certainly something that can cover them and their family if they are going to be out, because, as I have here, average disability length is about 34 months. So that's a long period of time to not have an income stream. Most of the topics on disability insurance you'll discuss with your own insurance agent, but I do want to give a couple recommendations and explain a couple of terms. Typically on disability insurance, you're going to want what's called a 90-day elimination period. 90-day elimination period just says from the day that I get disabled, when do I get paid? Okay, so if I get disabled today, under 90 days, the 91st day is when I'm going to get my first payment. You can make this 30 or 60 days, but your premium will be higher since they're going to pay you sooner on that. You can also go up to 180 days, so 6 months until you get your first payment. I don't typically recommend that. You will lower your premium, but you'll need to have 6 months worth of an emergency fund on hand, and typically the savings is not that great to take on. So 90 days is the basic recommendation. Benefit to age 65, because that's when Medicare will take over at that point. And then finally, there's a choice between any and own occupation. So the question is, does my disability prevent me from doing my own occupation or any occupation? So for a surgeon, as an example, a surgeon is somebody who certainly makes a lot of money and is using their hands all day. So if they go skiing this weekend and because of all the rain and slush, they get into an accident, overall they're fine, but they lose the use of their hands. Maybe they have a tremble that prevents them from operating. If they have an own occupation policy, they're going to be okay because they're going to get paid because it can no longer be a surgeon. If that surgeon had an any occupation policy, which would have been cheaper, but if they had an any occupation, the insurance company is basically going to say, would you be able to be a Walmart greeter with this injury? Would you be able to be a cashier at Home Depot with this injury? Because if you could, we're not going to pay you. And that would be really tough for a surgeon who might be making $500,000 a year to then go to a salaried job of 25 grand a year. So certainly if you're a surgeon, a pharmacist as an example, who's on their feet all day, you're going to want own occupation. People that sit behind a desk and just talk or look at a computer maybe can consider an any occupation policy. Okay, moving right along here, we're going to talk about term life insurance. This is what we recommend. I know a lot of insurance salespeople like to put whole life insurance policies out there. We're not really an advocate for that. I'd say 95% of people should be with a term life policy, which basically means if I take out a term policy for 20 years, as the example is on this slide, for $500,000, if I die anytime within those 20 years, my spouse gets paid $500,000. That's it, end of story. After 21 years, it goes away. Whole life insurance gets sold. It's much more expensive than a term life insurance policy. It gets sold as a retirement savings vehicle, a college savings vehicle, a tax avoidance vehicle. I would say that there are situations where that exists, but for somebody young, they want to be really looking at just a term life policy. And I have a few examples here on how much that costs. You can see it's very cheap. A 35-year-old looking at $35 a month for that is not going to affect the financial plan. So term life insurance is a must-have. Again, another rule of thumb that really depends. We have 10 times your salary. So if you make $100,000 a year, you might want to look at $1 million in coverage. Looking at a term that gets your children through school and really gets you through retirement, I would say. So very common is a 30-year policy for a 30-year-old as an example. But again, that depends. If you've got a lot of debt, for instance, if you've refinanced with your spouse and now your spouse might be liable for that debt, you might want to take out a little bit more life insurance or even an additional 10-year policy. So we could certainly dive into those situations as they come up. One thing I'll just point out, if you ever want to log on to the website, ssa.gov, stands for Social Security Administration. You can go there and see things like what your Social Security benefit will be, or it's anticipated to be. But one thing you might also look at is, what would my spouse get if I were to pass away today? So there is a small payment that you could get from the Social Security Administration. I've looked up this for myself as an example. So if I were to pass away today and my wife and one child were left behind, they would essentially get about $30,000 per year from the Social Security Administration. So, if I make $50,000 a year, that's probably pretty good. After all the taxes that came out of my salary, that might actually replace their lifestyle. So I have $50,000 a year. I may not need life insurance. But if I make $500,000 per year, and now they're only going to get 30 grand a year from Social Security, that's going to really change their lifestyle, because we probably bought a house based on my income. We probably put my child in private school based on my income. So again, term life insurance to help with those kinds of things is certainly crucial. Okay. We're going to briefly talk about estate planning. Again, another topic that we have a whole other presentation on, but I do want to at least bring it to your attention, because it's another area that I even talked to 50 and 55-year-olds that have never sat down with an estate planning attorney, and that can really, cause some issues. I hear the saying sometimes that, I don't have to worry about it because when I'm dead, I'm dead. They'll deal with all that, and that's fine. I would look at this as a benefit for your family. If anybody's had to deal with this, for somebody that didn't do an estate plan, there can be a lot of arguing, a lot of court battles. I've got a couple of examples here in regards to Prince, who you may know or may not know, passed away recently and had no estate plan whatsoever. And over the course of the 1 or 2 years that it's been, about 45 people have come out and made claims against Prince's estate. I think I read somewhere that there was actually somebody in a Denver jail that said he was Prince's son, and they had to go through a DNA test and all that stuff. I'm sure nobody on this conference call is as well known as Prince, but these issues do exist, and they mean a lot of money for courts and a lot of arguing among relatives. So just drawing up the big three here: a will and revocable trust. Make sure that you have designated a personal rep, divides up the assets, but just keep in mind, beneficiaries on your retirement accounts supersede whatever you would say in a revocable trust. So make sure that those are updated. And then dictating a guardian for your children. You can dictate both who is going to care for your child and who would take care of the finances. Those two could be separate people if you wanted. Power of attorney would be looking at your financial and health, your financial situation, and taking care of your assets if you became incapacitated. And then finally, this third one, naming a healthcare proxy, and also directing your medical directive. Basically, when you want to pull the plug. And I've got a picture of Terry Schiavo here, a very well-known story for those that were paying attention to the news in the 2000s, early 2000s. Somebody that was not a celebrity, just simply fell into a vegetative state. And then there was an argument between her husband, who looked at her condition and thought, Terry would never want to live this way. She would want us to, let her pass away peacefully, versus her parents, who thought, well, technology is always evolving and maybe our daughter can be saved. Because there was an argument between those two, this poor woman's face is plastered all over the news as they go back and forth. I think Jeb Bush even got into this. I think even George Bush got into this at one point. So very well-known story, and what can go wrong when you don't outline these exact documents. So, sitting down with an estate attorney is not that expensive, usually around $1,500 or $2,000 to get a basic estate plan. The more complicated that you make it, like making restrictions on your money going to somebody at a certain age, might make it more expensive. So, you're going to want to think that through before making too many restrictions. Okay, let's keep rolling here. I just have a couple of ratios I want you to keep in mind, especially if you're getting ready to buy a home or have a home. We like to keep your overall housing expenses below 28% of your gross income. So if you make 120 grand, we want that to be below 2,800 a month, 300 grand below $7,000 a month. I don't see people typically struggling with this. In fact, most of my clients, I would say 15 to 20% is where they end up with their housing costs. The other one that's a little bit tougher, again, especially for somebody who's young with a lot of debt, might be the housing plus all your other debt. Trying to keep that below 36% of your monthly expenses. Again, the point of these ratios is to allow you to save toward retirement, save for your kids' college and other things. So, before buying that house or before taking on too much debt, let's try to keep these ratios in mind and make sure that you're not, underwater or in an unsafe position. Okay, we're going to start talking money now. And now going into retirement savings, let's just start with a very flat benchmarking, because whenever somebody's asking me questions about retirement, it really is a basic question of how am I doing? Where do I stand? Am I on track to retire on time? You may know that people are working later in life into their 70s because people are living longer. And as opposed to 20 or 30 years ago, where a lot of us might have had a pension from work, instead, those pensions have really gone away, and now it's on us to save for our own retirement. And so I've given you a benchmark here to think about and consider whether you're ahead or behind. So simply take your salary, take what your individual salary is, multiply that by the multiple by your age. So if you're 35 years old and you're making $100,000 right now, by now you should have about $100,000 sitting in 401ks or IRAs somewhere. Again, if you're 45 years old, somewhere around $300,000. And again, if you're doing this with your spouse and you make a combined $200,000, at age 45, you're going to be wanting to look at something like $600,000 saved up. Typically, this is the slide that I put up where people start to say, okay, that doesn't really seem right. And it seems like a really big number, and I'm not really sure if that exists. I will give you some of the backing on this to show that this is what you want to be paying attention to. But just a couple things to think about. I've just noted here, if you're looking for percentages, around a 10 to 12% deferral rate, including your match. If you start that at age 25, you're going to be doing pretty well. Somebody that's a little bit older and starting later might have to defer more. We'll talk about that soon. And then finally, something that people might not know is that in a 401k, the maximum that you can defer is $18,500. If you're over age 50, it can be $24,500. But there's actually a cap on putting into a retirement plan that's actually $54,000 for under the age of 50, and I think it's $61,000 over the age of 50. And again, you may not be aware of this unless you're a business owner, but there are ways of doing that, especially as a business owner, with things like a profit sharing plan or a cash balance pension plan. So if I have business owners on the call here today that may be looking at this and seeing that they're a little bit behind, just know that there are ways for you to catch up and lower your tax burden toward that retirement goal. Just as a reminder, the whole point of these retirement plans, beyond just investing and getting, say, a 8 or 10% investment return, there's a huge tax deferral for those that are, making significant money. The point of putting it into a 401k is to say, I don't want to pay taxes on this right now when I'm making a lot of money. I want to pay taxes on this when I'm 70 or 75, making little money and in a much lower tax bracket. For some people, that might mean going from today's roughly 40% tax bracket when you consider federal and state, down to a 15% tax bracket, especially if you move to a state with no income tax. So I would really look to load up on retirement savings wherever you can. And just know if you're already maxing it out, there may be another option for you out there to continue that. This is a little bit of an example that you may want to walk through yourself just to figure out, where do these numbers come from? Because what we try to work with our clients on is a safe withdrawal rate during retirement. So I've outlined a little bit on the lower side of this slide here, a 5% withdrawal rate. Where these numbers come from are when I'm working with a 65-year-old, we're trying to get roughly a 5% long-term return on their investments. And so if they were to withdraw 5% from their account, let's just say they had $1 million sitting there, 5% of that would be $50,000. They could take out 50 grand for their living expenses, but if it also earned 50 grand, now they're still at $1 million flat. And obviously markets don't just go at 5%, they're going to go up and down, but that's kind of the goal. And you'll see different studies out there about whether it should be a 4% withdrawal rate. We're comfortable with a 5% withdrawal rate. I will say if you have to use a 6%, you're probably going to spend that money down over the course of 30 years. But if you're 65, that gets you to 95 and you're probably okay. You just will not pass away with any money. But to go through the example really quickly, you could take your example, your income, let's just say $150,000, use a wage replacement ratio of 75%. This basically accounts for you not paying as much taxes. You're not driving to work every day, so you might have less expenses there, but your medical expenses might go up. So a lot of studies have been done around this number. We use around 75%, which means you're going to need around $112,000 every year. You might get about 40 of that from Social Security. I've given you some averages and maxes on that, which leaves you with about 72 grand to fund retirement. Divide that by 0.05, and that gives you your round number here of what you would need to be able to retire, kind of that big last number. Let's bring that into context here. I think one more point that I want to make on this, or two more points actually, is that the more you make, the more the burden is on you. So once again, remember that somebody that's making $50,000 is going to have a lot of their retirement replaced by Social Security. You know, they might get a $15,000 a year benefit, so they still have to have save for retirement to some degree. But for somebody who's making $300,000, you know, Social Security is just going to be a drop in the bucket. Instead, they really have to go on their own. So another, misperception is that if I'm maxing out all my retirement accounts, I'm going to be fine. Probably not, actually. You could see what the annual savings are needed if you were starting at zero today. So let's just say a household making $150,000, they're going to need to save, if they start at 25, roughly 13% of their income. If they start a little bit later in life, they're going to have much higher rates that they require. Okay, and so finally on this note, the earlier you start, the much easier this path is going to be. You know, even if you're just increasing it at 1% per year, or throwing an extra $1,000 into an investment account, I just want to show you the power of compounding interest in this example, because we have 4 different people with just fantastic names. I haven't made up these names. JP Morgan has actually gone through and done this wonderful example where we have the same kind of people. They're all investing $5,000, all earning 6% on their investments. But consistent Chloe, she starts at age 25 and goes to 65 with that same dollar amount, investing $200,000 total. She ends up with $820,000. Okay, so she does pretty well, and is probably going to be able to retire on time. Late Lila, she starts 10 years later, age 35 to 65. So she only invests 150 grand. She ends up with $419,000, so half of what consistent Chloe ended up having. Quitter Quincy, on the other hand, she started early, age 25 to 35, but then she stopped. She actually did almost as well as late Lila. Okay, she only invested 50 grand versus late Lila's 150, but ended up there because she started so early and had compounding interest working for her. So, really a notion here to how this can pay off for you. And then finally, we got Nervous Noah here, who did get the message about saving early, but only was investing in bonds, did not invest in stocks because he was afraid of how the market was going to go up and down. So he only got 2%, and he actually does the worst here. So, you do have to invest aggressively when you're young, but you also have to invest early. It is a combination of the two. Okay, we're coming to the home stretch here. Just a brief note on investment allocation. I mean, this is something that we certainly spend a lot of time on with our clients. This is just a very general recommendation to say that you should have more stocks when you're young, more bonds when you're approaching retirement and at retirement. I'll also say that as a young person, this stock compilation might be more emerging markets or small cap stocks that will have a lot of volatility in today's market, but over the long haul will have better returns. While this 65-year-old, this stock component might not have a lot of small cap stocks or emerging markets. It might be more high dividend paying stocks like Coca-Cola or Duke Energy or Walmart, stable companies to make sure your assets aren't eroded. Target date funds are a great way to, simply do this. They're not the best option because they aren't diversified as far as the Fidelity Freedom Funds only are in Fidelity mutual funds. So you're probably going to lag on performance on those. But they're great to make sure that you kind of stay on track with your asset allocation according to your age. Okay, a couple last notes here. I do want to make sure I mention long-term care because for those that are in the call that might be in their 50s, let's just say age 55 to 62, you're going to need to make a decision whether you want to put aside money for an eventual long-term care event, such as Alzheimer's, where you might need to go into a nursing home, or if you want to take out a long-term care insurance policy. It's a tough decision, and we basically have recommended it both ways based on the client situation. Briefly, I will say that, if you don't have a lot of assets saved up, you're probably going to be spending those down and looking at Medicaid to take care of long-term care issues. If you have a lot of assets, you may have a situation where you could self-insure, put aside 250 grand or 500 grand to say, if I need to go to a nursing home, that costs on average $120,000 per year. We've got some money set aside for that. But really, everybody in between, let's just say net worth of $800,000 to up to $3 million, that's the tough spot because, you probably don't have enough money to affect the financial, that won't affect the financial plan and to be able to pay for it yourself. Instead, you may want to consider having that long-term care policy just to say, I'll pay the $4,000 or $5,000 per year in premiums to have this cost taken care of. So I can, now plan in retirement, go enjoy my money however I like. Even though Warren Buffett has all the money in the world, he actually has a long-term care insurance policy for this very reason, because he doesn't want to have to liquefy assets, and he maybe doesn't want to have his heirs in charge of what kind of facility he's going to go in. So there are a lot of reasons to take one out. There's a lot of reasons not to take one out, but just something to make sure you're at least thinking about at that period of time. Okay, last thing here, I've got a slide here on education. And again, we have a whole other presentation on this, but just to give you some benchmarks of what you should be thinking about, basically we're talking about 529 college savings accounts. If you haven't heard of those, you should definitely come to my next presentation or look them up. Essentially, it's a tax-free way of being able to save for college. As you guys know, college costs are going up extraordinarily. And I've given you some benchmarks here as far as how much you would need to save to be on time. So a lot of people might be looking at $3,000 or $6,000 per year to get somebody into a university that today costs $15,000 to $25,000. College inflation costs are roughly 5 to 6%, whereas regular inflation is about 2 or 3%. So, the cost of college is a big one, and it really involves also a philosophical conversation of, are we actually going to pay if they go to Harvard, or will we pay half, or will we pay just the in-state tuition? But the point here, and as I've outlined on the bottom, is to make sure you've gotten everything else I've talked about today taken care of. We all love our children, but just remember, they can always go and get loans for this kind of thing. They can always work to get through college, whereas, retirement is not going to be something that anybody gives you a loan for, if you will. It's something that's going to be a little bit more of a burden for you. So keep these in the back of your head if you're in an advantageous position to be already ahead on retirement. Because this cost is quite inhibitive. Okay, so that wraps up the quick and dirty personal finance checkup. We definitely made it very quick, and I know I've really breezed over a lot of topics here, but again, knowing that everybody in the call comes from a different situation, I'm hoping everybody can take away just one or two things. And again, this is my most broad presentation, so the others will go into more deep dives of some of these strategies, but hopefully I've given you something to consider. Our website, fncadvisor.com, I think you should check out to learn a little bit more about us. We also have a newsletter that we put out every couple of weeks, just giving you our thoughts on the market, giving you our thoughts on personal financial planning strategies that you can enact. So take a look at that. And then here is my contact information. Again, our website for our blog is on here. My LinkedIn is on here. Feel free to reach out with questions. I'm always happy to answer questions free of charge. If it takes 10 or 15 minutes just to give you some advice, you'd be surprised how quick we can get some things done. And then obviously happy to talk a little bit further about your situation if you've thought about working with a wealth manager to bring everything into focus and kind of make the recommendations for you so you don't have to go through and research all of these different topics we talked about today. So that concludes my presentation. I thank you everybody for joining us today, and I hope I see you at some of our other presentations. Thanks again.